The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. This is Bobby Rains here for our once every 3 weeks Investors Observer member-only workshop. Let's get started. So we have the same agenda as we normally do. We have some updates about what's going on in Investors Observer. Then we will do a little bit of an update on what's going on in the market. And then the rest is member-driven content, questions, site demonstrations, etc. We got a bunch of questions ahead of time this time. That's great. I love that. But we will have, somehow I skipped to the end. Hang on a second here. There we go. Okay, yeah, that we should still have plenty of time for questions during the presentation if you just want to put them in the box, and then next time around, if you have a question ahead of time, you can just reply to the email and send us a question that way. So what's going on in Investors Observer? We sent an email a few minutes ago letting people know we had an update to the site. But if you haven't seen it yet, there we go. We have this new sector and industry page. You can get to it in the drop-down menu from stocks and then sector and industry. And so this will let you sort through the various chunks of the market by, the various scores. So this is sorted by overall score. You can sort by fundamental score, valuation, sentiment, anything in between. So there's 11 sectors in the grouping that we use. You can click to go through to one of the sectors to see, it should show you the industries in that sector and then some of the top ranked stocks. Trying something new here with pushing it out right before we did the workshop, so bear with us here. We tested it a lot, but it doesn't seem to be working right now. All right, well, we'll come back to that. That's pretty cool. I hope everybody likes it. Send us questions or comments if you have them. So let's talk about the market and then we'll come back to the sector and industry pages and hopefully they'll work then. All right, so this chart is 1 year of daily candles. There really isn't that much exciting to talk about. We did sort of surpass that the previous peak, and then a couple of times here we're not back to the other sort of pre-coronavirus high, but we're getting there. One thing I did want to show everybody though is instead of doing the usual closer in chart because there isn't that much interesting going on, here we have the S&P 500 in white and the S&P 500 equal weight index in blue. And the equal weight index is basically it's the 500 stocks in the S&P 500, but each is given an equal weight as opposed to them being market cap weighted, which is how the S&P 500 works. So you can see the equal weight has lagged. The lag got the smallest at this point, and then the gap has opened back up again. This point is June the 8th. I don't know if anybody remembers last time. We spent a lot of time talking about June the 8th. June the 8th was the point in time when, June the 8th was the point in time when coronavirus cases were the lowest. It was the previous high for the market. It's this point right here, I believe. So yeah, that was kind of an interesting point because it was really sort of, we went from what we were calling the stay-at-home trade, which is, right, big tech does well because it doesn't need people moving out and about to do well, as we'll talk about a little bit later, to sort of, right, this big recovery here was the sort of, rise of the reopening trade. And then, yeah, June 8th, the new coronavirus cases bottomed out. A bunch of other stuff kind of turned around about the same time. And since then, the reopen trade has done well, and the stay-at-home trade has done less well. So yeah, that's kind of where we are with that. And let's talk about what else. So uncertainty is certainly sort of everywhere. The whole cycle continues to move faster than traditional economic data sort of can measure. The data, including earnings reports, is always backward looking, whereas the market tends to be forward looking, or at least it attempts to be forward looking. So that's always sort of an interesting thing to try to deal with. So people have started looking at a bunch of alternative data, which we talked about. We've talked about some before. We'll talk about it again in a few minutes. Reopenings and reclosings are a process. I couldn't even begin to tell you how many states or cities have. Yeah, it seems like it changes every day. People are opening things or closing things. The trend seems to be more toward closing now than reopening, but I expect that will probably move back in the other direction at some point, and then we'll see if it can stay that way. Yeah, so schools are kind of a big deal right now, both the sort of, K through 12s and then also universities. InvestorsObserver is based in Charlottesville, which is a big college town. It's obviously important for the economy of the town. For those, several thousand people to show up here in a couple of weeks, but we'll see. We'll see. The school pushed back any sort of in-person thing by 2 weeks, although they're starting classes virtually on time. Obviously, K through 12 schools, those being closed can present some headaches for people who have to work. It's very hard to go to work if you have young children at home. A lot of school systems are trying to do some sort of virtual or hybrid thing, which is going to make spending 40 hours a week in an office for parents very, very difficult. And yeah, the sports generally are struggling, right? Obviously, college towns, the economy is affected pretty big by, sports. That's a big thing, right? Like here in Charlottesville, there's thousands of people that move to town for the school system, and then several thousand, or for the university system, and there's several thousand more that come 5 or 6 weekends in the fall for football games. And then you have basketball and other things, and other smaller sports also. And it's going to be interesting to see if they can pull that off. The NBA's model seems to be working, but the NBA's model, basically, they put everybody in a bubble at Disney World. And there's sort of limited just people coming in and out, and that seems to be working. The MLB has already canceled a bunch of games and postponed games, and the hometown Washington Nationals are playing without one of their big stars, Juan Soto, right now, which makes the product a little bit worse, to be honest. So yeah, it'll be interesting to see how long sports can go. Those are things that in the media and also the localities where those things happen can have a big effect on the economy. And then, the employment recovery is also starting to look a little shaky. ADP, which is a private payroll processor, puts out a report. It is sort of notoriously noisy in the sense that it doesn't necessarily track with the the government data in normal times. But 167,000 versus 1.5 million is a very big miss there. So people are still expecting a gain from July, or a gain in July when those numbers come out on Friday. We'll talk about that in a second. ISM, the Institute for Supply Management, published their manufacturing and non-manufacturing reports this week. Both showed some expansion overall in terms of like orders and activity. but employment actually contracted in both reports, which is not great. It does suggest that people are willing to operate their businesses, or at least have been willing to operate their businesses with some amount of slack. If you can, if you can increase output while decreasing employment, it may be, people reaching the end of those PPP loans might be one of the reasons that happens. But yeah, we'll see how that works out. And then yeah, the weekly unemployment claims data also seems to have bottomed. We talked about this a little bit on Friday in our Friday post, but the new claims and the continuing claims numbers were going down there for a while after a big spike back in the spring, and they both sort of started moving in the wrong direction. So now the survey week for the monthly situation report, which is the big, that's the report you get the first Friday of every month that has the unemployment rate and how many jobs the economy added and all those things. The survey week is the week that contains the 12th, which was pretty early in July before some of the stuff got to be not so good. So it's possible we'll see gains for July. But again, right, like this data is slow and on a big lag and possibly not entirely accurate. So let's go through to some of what we're calling our fast data. This is data that just has much less of a lag. So this is from JP Morgan's daily consumer spending tracker. Card spending has moved in the wrong direction. Again, I think, this has lagged a little bit. The June 8th thing doesn't quite hold up, but the recent high is about a week later. And then, it's been sort of flat to down since then. The recovery seems to have kind of stalled out there. Here we are from July 15th. You can see the difference. It's picture has generally sort of gotten worse as opposed to better. Right, and then from the TSA, the bars are passenger screened by the TSA per day, and the red line is a 7-day average. This is kind of interesting. The low days end up being during the week, which kind of fits with some of the things we've seen with some data from airlines. Business travel is down much further than leisure travel, which is kind of interesting, which has hit the sort of legacy carriers harder than like Spirit and Frontier, and some of those airlines are actually doing better in terms of seeing passengers come back than the legacy carriers that cater mostly to business travelers. I mean, this is pretty obvious. You can see things have leveled off here. Earlier, we started doing this chart, which just shows the daily rate of change in that 7-day average. And so, moving up here means that the 7-day average is moving up. Moving down means the 7-day average is below the zero line means the average is moving down. And you can see it's just kind of stalled out, which is not great if you're in the airline business. All right, so before we get into the questions, let's go back to the website here and see if we can get those pages to work. All right, let's try a different one this time. Well, it doesn't seem like it wants to work. All right, well, we'll do here it goes. It seems like I'm not logged in. Interesting. There we go. Now I'm logged in. Okay. So, once you click through from a sector, you go through, and so this is a list of all the stocks in the technology sector ranked by their sentiment score. If you want to see the fundamental score, you just click there. Obviously you can click through all of the scores. We have news about things in that sector down below. And then, so here's the industries in the technology sector. If you wanted to drill down into, say, solar, you can click here. Yeah, you're supposed to be able to click there. All right, this may still need some work. It's also possible I just didn't refresh it enough before we got started. Everyone should probably do a hard refresh, which is Control F5, or I think it's like the helicopter button, whatever that bunny looking thing on your Mac is. Yeah, so this is, for those who came late, it's now on the stocks drop down under sector and industry. So you can see we've got 11 sectors here. And then, so this is a list on this main page, a list of all of the industries. So if you wanted to look for something in particular, this is just the top 10, and it will change depending on how you sort. But if there's something in particular you were looking for, like biotech, you can see, all right, well, that's number 75 as sorted by long-term technical score. And then you can click through, see if we can get this industry page to open up here. There we go. So you can click through here. We have pages like this for each industry. So this is just the stocks in this industry. And you can go back up to the sector from here if you want. And then we have this here that will take you to the stock screener with just every consumer cyclical stock, and you can sort it through there using the screener in the various ways if you want. So yeah, check that out. Let us know how you like it. It seems to be faster once you've opened the page once or twice. But we are also constantly, I think probably anybody who runs a website is constantly fighting a battle to make everything faster. So we are working on that as well. All right, so that is that. That is our exciting new thing at Investors Observer that I meant to get to earlier. Now we're on to the questions from users. So from Nick, he asked, am I able to search for stocks by filtering them by analyst recommendation to sell, hold, or buy? That's a pretty easy one. If we go to the stock screener, you can in fact do that. It is under average recommendation. So this will give you, yeah, you pick one and it does the thing you asked it for. It will give you everything higher or lower. So hold will give you just the hold. Picking buy here will give you buy and strong buy. Picking sell will give you sell and strong sell. Strong buy will just give you the strong buys, and strong sell will just give you the strong sells. But yes, you can absolutely do that. All right, so how does the put and call work? I'm assuming that the put and call here is talking about the put and call ratio in the morning update, which you can find in your email box, usually between 8:30 and 8:45 most days. But it's also on the website under morning update. So here's today's. And the put call ratio is here. And this is just the total number of, we use the equity put call ratio. So the total number of calls traded on stocks versus the total number of puts traded on stocks. It is sort of a sentiment indicator, is really how it's designed to be used. And so, yeah, more calls than puts is, and it never really gets to 1, right? The same number of calls and puts would give you a 1 as a ratio here. 1 is actually sort of bearish. The skew is generally toward the bullish side. So it rarely hits neutral. It does go above 1 when things are particularly bearish, like back in the spring, but it doesn't necessarily. Yeah, a neutral day in the market won't necessarily have a 1 put call ratio. All right, so that's that. All right, so this question was from Douglas. He asked, when you manage an iron condor, does it ever make sense to just close the tested side or close it and roll the untested side or roll out to figure to a future date if you can still get a credit? So it can absolutely make sense to close one side. It can even make sense to close a particular leg. In terms of, I mean, certainly doing something with the tested side is a good idea. That's so you don't lose money. Right? But if there is if you have an iron condor, which is a bet that a stock will stay essentially between two prices, and the stock moves really far in one direction, you may want to even buy back the sold leg on the what we'll call the untested side here, right? The price that the stock is moving away from, because the price of that option will go way down. But there's no point in selling the bought leg on that side because, right, you're going to have to pay, and then the price on that can only go up. So you can buy back that sold leg as the price goes down, and then if the stock comes back the other way, the price of your bought option will go up. So that's another thing you can do. I think once you get into an iron condor, all four of those legs are in play. There's no reason to treat them as a unit of four or 2 units of two. I think moving all four legs in and out is probably the way to do it. Generally, in terms of rolling, my philosophy is not to roll vertical spreads. Rolling a vertical spread involves closing all the legs and then opening opening a whole new trade somewhere else. And at that point, I just kind of have to wonder, like, if you picked a trade because you thought you had some sort of edge or handle on what the stock was going to do, and the stock just did something different than what you thought, is there a reason when you close your first trade to open a new trade on the same stock? I'm not sure there is. I think that there are tax implications and some other reasons that people do that. But I think a lot of times it's hard-headedness and not wanting to take an L. But generally, yeah, trading is a series of wins and losses. Putting money into trades that go bad to try to turn them into winners doesn't work out very often. I mean, yeah, they make a movie about you when it does, right? Like that's The Big Short. There are a lot of hedge funds that go broke just sitting on their trades because they really believe in it. So generally rolling a vertical spread is not something that we stick with just because it doesn't make a ton of sense. All right, so we got a couple questions from, I'm not 100% sure how to pronounce the name here, but there it is. The first one was, I'm an option beginner and one of my call options is at a loss. It expires August the 15th. Can you sell it before the option expires to reduce the loss? The answer here is yes, you can absolutely sell options before they expire, right? It's just a sell to close order. I would say that not only can you, but you probably should consider selling, even profitable options because you can recapture time value. Right, the time value goes to zero when the option expires. So what a lot of option traders will do is buy an option with the intention of only holding it for some period of the time to expiration. So you buy it and then you get out before all the time value leaks out. Because yeah, if you hold an option to expiration, you essentially, you get whatever, either zero or you own the stock, you purchased at the strike price less your initial credit, or your initial debit rather. But if you sell the option back to the market early, you can recapture some time value, and there's very much no reason not to do that. You can also buy back sold options early. I sort of alluded to this in the Iron Condor answer. But if you have a covered call and the stock goes way down, any sold option is a short position, right? You're betting then that the price of the option will go down. So if the stock goes way down, the price of the option goes down, you can buy it back. If the stock comes back up, you can sell the same option again. We've done that. That totally works, and is a completely fine strategy. There's very much no reason to hold options to expiration, especially now that option trading commissions are zero. Or negligible. There's even less reason to hold things to expiration. All right, so why do stocks go down when the company does a public offering or private exchange offers? The answer to this is what's called dilution. Dilution is, right, so if you think about a share of stock as a partial ownership in a company. So if I have a company and I sell 100 shares, every share is worth 1% of the company. Well, if I sell 100 more shares, now every share is worth 0.5% of the company. I haven't done anything to make the company twice as valuable. And so what that means is your share should be worth roughly half that amount. So that's why the price goes down. The same is true for, private placements, anything like that. Anytime new shares are being issued, you should, see the price go down. Sometimes that effect is temporary, not always. Things like things like Tesla, where there are just a ton of people who want to own that stock. You sometimes see that a little bit less, but generally, the dilution will cause the price to go down. All right. So the next question is from David. He said, this is pretty basic, but I don't fully understand how much the open interest in volume may affect option trades on thinly traded positions. Maybe something that's deep in the money. Just asking for general info, getting filled, selling calls and puts. This is a good question. Where this really shows up a lot is the bid-ask spread. Right, so like things that are more thinly traded tend to have a wider bid-ask spread. And what that means is it costs more to trade the option, right? Like not like there's a fee to trade the option, but if you think that there's a correct price for the option, let's say, typically you're going to have to buy it for more than the correct price and sell it for a little bit less than the correct price. So if the price changes a whole lot, you can still capture some gains there, but those transaction prices, what people call slippage, tend to be a little bit higher. Things like the deep in the money option used for diagonal spreads that we do often have pretty wide spreads. This is one reason to use limit orders, because we can put in a price that takes out some of that bid-ask spread. And generally, if we can find a price to use for a limit order that we like, we don't worry too much about the prices of the individual options. Right? Like if the price of the whole thing is something we're happy with, then what we pay for this one or what we get for that one is much less relevant. And we've never really had a problem getting out of one of these positions. Now, sometimes it's 3 o'clock on Friday of expiration, but that's right. Time value goes away. That's what happens, right? You'll get some value there. There's really a lot of people ask questions about thinly traded things and things like that, and it does lead to that slippage, but I've never had a problem. I mean, if there's a bid on the option, you can sell it. If there's an ask, you should be able to buy it. It may not be the best execution price, but it is 100% tradable. In the diagonal spreads portfolio in particular, we've absolutely, open trades with 0 open interest and closed them and had to go back to 0 after we closed the position and we made money on the trade. Like that's totally fine. If you're trying to day trade or something like that, where you're trying to capture a lot of small movements, then you don't want particularly wide spreads on your option. But for the kind of things we're doing here, it's not really an issue. All right, so Raphael asked if we could describe a bit more in depth the optimal covered call strategies and their risk assessments. Let's get back to the website here. All right, let's start over covered calls. All right, so the risk assessment is this key rating here. It goes from 1 to 5. 5 being the relatively safest trade, 1 being the relatively riskiest trade. So an important caveat to this is that the overall score is an evaluation of the stock, and the key rating is an evaluation of the trade agnostic of the stock, okay? So if we go back to the 5 keys, yeah, here we go. So 31 is in the bottom third of stocks in terms of the overall score, but this gets 5 keys. And the reason for that is we wanted to separate the two. You may be looking for something in a covered call and not agree with our evaluation of the stock. You may want to use them both together, which you can do in the screener here. Right, key rating and overall score, you can use them together, you can use them separately, doesn't matter. But what the key rating does for covered calls is it looks at the time to expiration, right? We'd rather have a short trade than a long trade. The way option prices work, and because of the way stocks work, where they don't go in the same direction, every day or every unit of time. The way this works is you tend to use a variable that is the square root of the time. So you typically want a shorter trade as opposed to a longer trade. And then the other thing we look at for covered calls is the sort of ratio of option premium to the width of the strike prices. So if you think about a covered call, if you wanted to roll it, rolling a covered call where you get $1 for selling the option and you have to move the strike price by $5 because there's only $5 strike widths, that's really hard to sort of defend that position in any way that's profitable. Whereas if you can turn that on its head, if you can get $2 or $3 in premium for selling options and they've got $1 strike prices, that works out pretty well, right? That's the thing you can play defense against. So those are the things that come into play here with the key ratings for the covered calls. And it's basically the same for the cash secured puts. The diagonal spreads, it's also pretty similar. I think there's also some metrics in there that look at how many times you could turn the call over, turn the sold call over before the bought call expires. And then the vertical spreads, it's really about sort of probability of assignment and time to expiration. All right. All right, so any advice on how to manage a covered call? And yeah, sorry, to get back to a couple of other things we're sort of alluded to in this first question. The goal of the covered calls you find most of the places on Investors Observer website is to be exercised. That's how that works. The one exception to that is if you go to an individual stock page, use Caterpillar here. If you go to the option trade tab, we do have this out of the money covered call calculator. And so, obviously if you put in 100 as your cost basis and say you're doing income, right? You want to generate some extra income and you don't want to have your stock be likely to be assigned. We'll find a call that's out of the money for you there. The position repair function, if say you bought Caterpillar for 150, we'll find a call that is going to make your position profitable if it's assigned. It's still right? Probability of assignment here is still 24%. But that if the stock should go all the way to 150 by November, you're profitable on this trade. It won't lock you into a loser, which can happen when you're selling covered calls. So that's a case where we have some trades on the site that are designed to not be assigned, but most of them are designed to be. It's written in such a way that you're expecting to be assigned. And yeah, any advice on how to manage a covered call when the goal is to keep the stock, but the option is in the money closer to expiration? So just like we talked about earlier, in the money calls can be repurchased. You just buy it back, possibly as part of a rolling strategy, although rolling up doesn't usually net you a credit. It just doesn't. Every once in a while you can get it to work, but it's not often. But the thing about this is essentially you're just moving money from one pocket to another. Okay, so you have to take cash to close the option position, but getting rid of that option unlocks the value of the stock above the strike price. So if you have a sold call that's $5 in the money, right, that position will only be worth the strike price. Right, if it's $500 in the money, your stock minus the value of your option is going to be the strike price of that option. So you spend some cash to get rid of the option, and it ends up being, if you wait till close to expiration, it ends up being, and let that time value go away, it ends up being roughly the intrinsic value of the option, which is how far in the money it is. So you spend $5 to buy back a $5 in the money option, but now the option goes away. Your stock that was worth basically the strike price of the option is now worth the market price of the stock, which is $5 up. So you're taking cash out of one pocket and you're, just sort of moving it to apply to the value of the stock. It's, people would prefer not to do that, but it's not as much of a losing situation as it seems like at first blush. All right. So Jose said he would like a clear explanation of how the projected prices are determined. I'm going to guess that he is talking about these projected prices. And these are the aggregated price targets of Wall Street analysts. Those guys cover the stock. They put usually their 12-month targets on things. You can see in the case of Caterpillar here, there's a pretty wide dispersion. Sometimes that happens, sometimes it's a lot tighter. My guess is Caterpillar in particular being tied to the global economy and the commodity prices. Yeah, I wouldn't want to try to guess either one of those things 12 months out, much less some output that has both of those unguessable numbers as inputs. So yeah, that's where that projected price is. And then yes, the option trades do disappear from the site in the evening. That's because we have an algorithm that runs once a day. It's overnight. We get a ton of data from a number of different vendors in the evening, and that all has to be uploaded and then processed. And then it takes a while to do that much math. It is a sort of future update goal to have that be much faster. But we take them down because those are the trades that were picked for the previous day. So they're 24 hours out of date at that point, and neither the stock prices or the option prices are accurate. So we take them down, and then we get the new ones up as soon as we can, which ends up being very early morning hours Eastern time. All right, Larry said, I have 10 shares of Novavax. He bought the stock in May at $31.89. Should he buy more? Also owns 50 shares of Sorrento at average cost of $9.20. Where would 2,000 be best invested? My first recommendation here, my first comment is I'm not a financial advisor. I know literally nothing about Larry's financial situation except for what's contained here. and so I'm not really qualified to answer. Based on what's contained there and owning 2 stocks, I would suggest $2,000 in cash be invested in something else, probably not biotech or even, just to get some diversification. But yeah, so let's look at these stocks here. Yeah, I mean, if it were me, don't think, I mean, without knowing a whole lot about either one of these stocks, I know the names in biotech. I don't follow them super closely because they all do something that's incredibly complex, and predicting drug trials is something that somebody else can do. Yeah, both of these look pretty extended if you ask me. I probably wouldn't put a ton of new money into these, especially if you're already sitting on gains. That's how I would play it. But again, yeah, I have no idea what the likelihoods of any of the drug candidates being developed by either of these companies working out are. That's really what you're betting on when you buy, especially these sort of small and mid-cap biotech stocks, is whether or not some drug that's currently in development will work. And I don't have the the skills or the foresight to be able to do that effectively. All right, so let's go back through some of the things that were mentioned earlier. Let's see, it looks like somebody had a problem with sound earlier. Hopefully that cleared up. If not, this is being recorded, and we'll send out a link to the recording tomorrow. It'll be posted on the website as well, but we'll send you an email when that comes up. Let's see here. All right, so Joseph asked if there's a way to get a stop loss price using our site. There are some tools built into the chart. If you hit view larger chart, you can do some things like, what's it called? Oh, that's not what I wanted. Here we go. Yeah, I mean, you can use the volatility stop here, which I don't have a good place to tell you to go read up on it. TradingView might have a better one. But yeah, basically it looks at some number of periods and the closing price, and tries to find a stop based on recent volatility. But that's, yeah, using stop losses is not really a thing that we have currently in terms of something on our site. But it is, the volatility stop is built into that charting tool, but that's the only real place we offer that. So somebody asked, what do we mean by vertical? So a vertical spread is an option trade where both of the options expire at the same time, whereas a horizontal spread is one where you have similar strike prices and different expiration dates, which if you think about those two things, you can back into a diagonal spread being different strike prices and different expiration dates. All right, so Terry asks, could I talk about having an investment account linked to InvestorsObserver? Sure, so under the My Portfolio section here, I'm not going to do it because I think I have my personal account linked here, and that's not something I'd like to share with everybody. Yeah, you can link accounts, investment accounts from a wide range of brokerages to InvestorsObserver. The link is using Plaid, which is a unit of Visa. and they have bank level security. Everything's encrypted. We don't have any access to do anything to your account. We literally get a list of what's in it, and that's it. And so what we do is you can see your portfolio weighted using our stock scoring system. So not only will it give you each of these scores for the stocks in your portfolio, we will also say, okay, well, Caterpillar makes up some percentage of your portfolio and Apple makes up some other percentage, and you have some other stocks here. Here is how these scores come together on a dollar weighted basis, you know, for your whole portfolio. That's what linking your portfolio will do. Let's see, Jose had a question about the issue price having an impact on the market price. I assume he's probably talking about new stock issuance from that question. And yes, so if there's a stock offering and the issue price is set either much lower or much higher than the trading price, the price will snap to that. Very rarely is it much higher. It's typically lower. Right? I mean, why buy the stock in a private placement or some other offering when you can buy it on the marketplace for less? That's how that works. All right, so here's a good question. How do I interpret the analyst ranking on a stock? Sometimes I see NA or 8 or 50. What do these numbers mean, and how do they influence my decision to buy or sell? So the analyst ranking is one of our scores. It's here. The same analysts who make these price projections also typically have a buy, sell, hold. Sometimes it's a 5-point scale, sometimes it's a 3-point scale. They have a similar rating on a stock. We take that aggregated data and turn it into a number, which gives us, if we have a whole bunch of analysts, we can say, all right, well, the average rating here is, something on a lot more points than 5. We can say it's sort of between hold and buy or between hold and sell, and we can rate those things. And then we can see across all the stocks in the market which ones analysts like the most. Now, an interesting thing about that data set is it is skewed pretty strongly toward the buy side. Let's see, Caterpillar has a 48. Yeah, okay. So Caterpillar has a 48, which these scores are all percentile ranks, so 48 is roughly near the middle. And yet the average or analyst recommendation is a buy. I won't get into a long discussion of the economic reasons why sell-side stock analysts don't keep long-term sell ratings on stocks very often, but typically an analyst will mark something as sell for a while and then they just stop covering it, or they upgrade it back to something else. Very few analysts have long-term sell recommendations on things. I mean, I'm sure there's some guys that have had sells on Tesla for 10 years. There are cases like that, but not many. And so if you want to find the stocks that people, these analysts really like, looking at just the buy, sell, hold doesn't tell you as much, whereas looking at our ranking tells you a lot. This will tell you, oh, hey, analysts like the stock. This will tell you analysts don't like this stock really much more than they like the average stock. And so that is how to use the analyst ranking there. Yes, we do have a covered call and a cash secured put screener. Our option trade screener, in fact, has 7 strategies: covered calls and cash secured puts, bullish and bearish diagonal spreads, bullish and bearish vertical spreads, and iron condors. All right, so we have another question here about the morning update. And that question is, can you explain an example of how to execute a covered call option suggested on daily option trades? So the trade in the morning update is a covered call. And what you're going to do is find wherever it is that your broker lets you enter what are called multi-leg orders. Sometimes they have a specific form for covered calls, but generally anything that lets you do more than one action at a time will work for this. And what you're going to do is you're going to buy 100 shares of the stock. You don't need to worry about this price. And then you're going to sell one contract of an option, in this case, the options that expire August 21st. You're going to find the 70 call. You don't need to worry about that price either, because you're going to put these two things into one order form and say, I want to buy these shares, I want to sell this option, and I want to pay not more than $69.11 for the two things. If you pay an extra nickel for the stock and you get an extra nickel back for the option, doesn't matter, don't care. $69.11 is what we want for the unit. The rest of it, right, I don't care. So you put that in like that, and that is how you make that trade. If Logitech is above 70 on August the 21st at the close, the shares get sold for $70 a share, and you make 89 cents per share in 16 days, which is an annualized return of 27%. If not, you own the stock at a cost basis of $69.11, and you can do whatever you want with it. All right, so Joseph says, in a nutshell, how much weight is valuation in a stock recommendation? A lot of stocks are overvalued, it seems. This is very true, Joseph. A lot of stocks are overvalued. Yeah, I mean, we can go look at, that's too many letters. Right, Apple, one of the stocks leading the market. Microsoft does better. Sure. My Facebook doesn't look terrible. But yeah, a lot of stocks are overvalued. Valuation is a component of the overall score. If you're a value investor, the stocks that are leading the market are maybe not where you want to go. Right? I mean, that's how value investing works. Typically, it's finding the things that are unloved that you think are overvalued. It's not buying the things that have just been going up, up, up. So that is, yeah, that's how you do that. Right now, it seems like momentum is where you're making money, much more than valuation. This has been a sort of long-running conversation in investing circles, is when will momentum start to lose and valuation start to come back? And yeah, I don't know. I think value investors can make money. They don't make as much money recently as the momentum investors, but there is still a place for that, I think. All right, so now that I did that, we got a question earlier that I want to circle back to, because we talked about momentum a little bit. Yeah, so is there a momentum stock screener was one question. And then a follow-up to that was MasterCard went up today, and how do we capture that momentum? So if you want to screen for stocks that have momentum recently, go to the stock screener. And so momentum really just means the stock is going up. When people talk about momentum traders, what that means is people who buy stocks that are going up and hope that they keep going up. And a lot of times that strategy works. So you can use our sentiment indicator to look for things that have a bullish or bearish sentiment, depending on the direction you want to trade. You can even go with the, that was not what I meant to hit. You can go with the very bullish ones if you want. So this will be a very short-term momentum indicator. Sentiment score looks at like 5 days. So if it's doing well in the last 5 days, Here you go. You can see, right, the overall rank isn't much affected by that. Because yeah, it's only been going up. It's doing well over the last 5 days. That's not particularly exciting necessarily. If you want a slightly longer look at things, you can go to the short-term technical score, which looks at the last, we'll call it month of trading. There's a different number of trading days in every month, so the absolute number of days can sometimes be a hair longer or a hair shorter than a month. But yeah, so you can look at that, and that will help you find stocks that have been going up over a slightly longer term if you want to look for momentum that way. But yeah, I mean, that's how you capture momentum, is buy stocks that are going up, that are going to keep going up. And so let's look at one of these guys here. Yeah, okay. So this chart is, right, it goes up, right, up in a nice, it's not smooth necessarily in terms of being a straight line, but it goes up. It's not super spiky. It doesn't move, bang around like crazy. Whereas if you think back to when we looked at Invex earlier, right, this is what looks sustainable to me in terms of it's been doing this thing for a while, and it looks like it might keep doing it. Whereas Novavax, let's go back to year to date. This is a much steeper line, right? It just, yeah, it's less likely to keep increasing in price that quickly is really sort of what you look for with your trading momentum line. Obviously, if you could have grabbed it here and ridden it to here, that's great. But what are the chances you can get another move like that again? It doesn't seem super likely. All right, let's see if there's anybody I missed. It's about time to wrap up here. All right, so we got some questions about bull put spreads. Bull put spreads are a type of vertical spread. We publish a lot of them here. They're in the screener. They're also in the investors keyhole trades that elite subscribers get in their email box 4 times a day. And it's pretty simple. It's a bet that the stock will stay above the strike price of whatever the sold option is. Let me grab one of those trades real quick and we can talk through it. Investors keyhole. All right, so what we're going to do in this trade is we're going to sell the September 6250 put, and we're going to buy the September 60 put. We didn't even give you the prices for the individual options here because, again, don't care. What we care about is we're selling this one, which has a higher price, and then buying this one, which has a lower price. And so we're going to enter this trade for a credit. We get paid to make the trade, basically, right? We don't have to pay to get in. We get paid to get in. So we get a 25-cent credit to get into this trade. And all we're doing here is betting that the stock will stay above 62.50. The stock stays above 52.250, or really is above 62.50 at September expiration. It can dip below and then come back, and that's usually fine. Options expire worthless. We keep the 25 cents. What we actually have at risk here is the difference in strike prices, which is 250 minus that 25 cents we got up front. So the most we can lose here is 2.25. So that's like an 11% return in, we'll call that 2 months, a month and a half, something like that. So yeah, that's the real short version of the bull put spread. If you're interested in more about any of these particular option strategies, you can go here and we have them all spelled out. A decent article here. Some of them have charts in terms of like what the P&Ls are and things like that. That was a little funny. But yeah, the Help Center has pretty good descriptions of basically everything we do here. All right, so it has hit the end of my time here. thank everybody for coming. Like I said, this has been recorded and we'll send out a recording tomorrow. But yeah, thank you all for coming. Please hit the help button on the website if you have any problems, questions, or concerns. We also are here answering the phone from 8 to 5 Eastern time. So yeah, thank you all for coming, and don't be afraid to get in touch with us if you need anything.